Hello, and welcome to our conversation on essential carbon terms and concepts. I'm Danny Norlander. I'm the Forest Carbon and Forest Health Policy Analyst with the Oregon Department of Forestry, and I've been participating in the National Association of State Foresters Forest Carbon Markets Work Group. Today we're going to talk about a variety of terms that you may hear about as you hear about forest carbon offsets and a variety of things associated with carbon markets. To start off with, let's do a quick slide on what we mean by storage or sequestration. And these are kind of the building blocks for the rest of the carbon market conversation. So carbon storage is the carbon exists in the different pools, and we'll talk about pools in a minute, in the forest, whereas sequestration is the process of removing carbon from the atmosphere and moving it into some of the storage pools. In natural systems like forests and ag lands, photosynthesis is the process that's used to do the sequestration. There are anthropogenic processes like direct carbon removal that also do that, but we won't be talking about those today. So to start off with, what is a carbon offset? So carbon offsets are activities that compensate for the emission of greenhouse gases. So as a company or an entity emits carbon, they're able to purchase a carbon offset, which will allow them to continue to emit that carbon into the atmosphere. So variety of carbon offsets that you see in forests are through conservation effort, reforestation or afforestation, and improved forest management. These activities represent natural climate solutions that might be eligible for carbon credits in the various markets. Carbon offset projects are issued carbon credits for the amount of carbon dioxide equivalent, so CO2e, that the project provides. So CO2e is different than a ton of carbon, and that's an important thing to remember. So there are two different types of markets, regulatory and voluntary markets. Regulatory markets are set up through government regulations to limit the amount of CO2, and the carbon market associated with that provides an alternative compliance mechanism where the covered entity is able to purchase those credits and can offset their emissions to meet that limit. Often, as I mentioned, those alternative compliance mechanisms include natural climate solutions or direct carbon capture. And as such, there's a couple of examples in the United States, including the California Cap and Trade Program and the Regional Greenhouse Gas Initiative in the Northeast states, also known as REGI. There's also international regulatory markets that are applicable in the US to some degree. Whereas voluntary markets, so emitters or interested parties pay for the additional sequestration as a voluntary action. These aren't required by any regulation to reduce emissions. Voluntary markets tend to be a bit more variable than the regulated markets, both in their price, the size of the projects, the methodologies that take place, and the terms. So that's like the length of the contract, how much carbon is being removed, and things like that. So examples would be airlines or companies purchasing offsets to meet goals, either inward or outward facing goals, towards being more carbon neutral. Protocols and standards are put in place to really define how the carbon offset projects are developed and implemented. They outline exactly how the activities take place and how they're going to be measured and accounted for down the road. They determine how long projects must continue. So whether that's 1 year, 5 years, 10 years, 30, or 100, it really varies on the protocol or the standard, and there's a variety of them out there. And they tend to set the measurement methodologies for the projects so that people will know how to do the measurement associated with that project. So all this takes place in kind of a registry or exchange world. So carbon registries and exchanges operate as the marketplace for carbon credits. Independent third parties verify that the approved protocol was followed. And then the carbon credits are issued and tracked with unique serial numbers to prevent double counting so that you aren't able to sell that same carbon credit in more than one place. Project developers and exchanges generally require landowners to enter into contracts before transactions occur. These contracts are legally binding documents They define the delivery of carbon credits to the purchaser. They include protections for both parties in case something were to come up, like a wildfire or a hurricane or some other type of damage. So considerations include the duration, the credit insurance, so if that's going to be before or after an activity takes place, adherence to the protocol rules, and any penalties for contract violations and what those may be. So existing markets vary in how long they define the contract. Like I was mentioning, there's 1, 5, 15, 20, 100 years, and it can really depend on the exchange of the market and the protocol, how long that will take place. So these same documents help to issue the credits, they monitor the projects, and they provide for what the penalties for any violations might be. Eligible activities that can participate in carbon markets include things like afforestation or reforestation, forest management activities, avoided forest conversion to either development pressure or agricultural land or other uses. There are markets in urban forestry settings, and then for harvested wood products after the wood leaves the forest. So it's important to remember that forest carbon credits are not simply locking away forests. And in many cases, you actually don't generate significant carbon revenue in the long run unless you're doing active management through a variety of activities. So the carbon pools that I mentioned earlier are really essential to the forest carbon marketing program. And it identifies where the pools are on the landscape, and it helps associate what the activities produce in the long run. So they include things like above ground live biomass, so that's the bolls, the branches, needles, etc. Below ground live biomass, so that's the roots, any beneficial ectomycorrhizal fungi that might be associated with that. Dead biomass, so that's your bolls on the ground, branches, etc. Stuff contained in the soils, litter, and then again, once the wood leaves the forest, the harvested wood products that may be produced. So measurement and monitoring. So forest inventories can be used to accurately measure the amount of carbon stocks in a forest. This can be traditional forest stand cruising, or there's a variety of other methods that can be used. So any quantification method employed should balance precision and accuracy with cost effectiveness. If things are too costly, they create a barrier to entry for landowners into the carbon markets. So forest carbon markets have employed a variety of different measurement and monitoring processes, including reference tables, direct measurement. So that's things like cruising, the stands, growth and yield models, and we're seeing more and more remote sensing techniques being developed with increasing LiDAR and FODAR and things like that coming online. So baselines and additionality. So there's a couple of different methods for baselines. One is the business as usual, which measures the increase in forest carbon stocks on a project compared to a representative area where would be an absence of that project activity, often called the business as usual area. And then base year approaches where you compare project specific measurements from one period to the next. And then additionality is to generate marketable greenhouse gas emission reductions, the project must sequester carbon that is in addition to what would have occurred in the absence of the project. So additionality is the idea that you're not going to be paid for the benefit that you would be providing anyways. That leads us to permanence. So how long are these benefits from the carbon market going to persist? So permanence is addressed the degree to which sequestered carbon is permanently removed from the atmosphere. And that permanently isn't actually into perpetuity. And oftentimes with carbon projects, you'll see that there is harvest allowed after a certain amount of time or a certain amount of carbon removal through time to provide additional funding streams to landowners. And along with permanence, you have insurance mechanisms that are generally in place in case there's a decrease from a disaster or other things. These include things like buffer pools, where you have carbon credits to go into pools, buffer pools to provide that. You know, financial insurance, much like you would for your house or for your car, like kind pools, and then biological risk management are a couple of other insurance mechanisms. So leakage often comes up, and determining the direct impacts of one landowner's decisions on another landowner's is exceedingly complex. So saying what one person does and how that impacts decisions of another gets to be very, very difficult. And there's a variety of different kinds of leakage, whether that's internal, so internal to that landowner or that land manager, external, so that's looking beyond that landowner. Then you have things like market leakage, activity shifting, so moving from one activity to a different one, and then positive leakage, where you can actually have an increase in carbon because of the project that may be taking place on a different parcel or a different landowner. So verification, this is that third party verification that takes place, and carbon projects utilize a third party often to provide more certainty that things are actually taking place that are being said they are. So this is done in line with whatever is stated in the contract, and that the carbon benefits realized through that project are actually taking place. So there's a couple of methods generally used, and these include both field and desk verification at the time the project starts, and periodically throughout the length of that project. So aggregation really comes about when you're talking about smaller landowners, and that is probably a primary role for some of our state forestry agencies. So it can be very costly to enter the carbon markets. There's high transaction costs, and aggregation can help to bring those costs down. So an entity with sufficient upfront capital acts as the go-between, so kind of a middleman between landowners and carbon buyers and project developers. So they'll bring in a variety of landowners, aggregate those projects together into one contract, and then that contract is the one that moves forward and is verified to provide the carbon benefit over time. And lastly, co-benefits, stacking and bundling are kind of the additional benefits that are produced through offset projects, such as protecting water quality or quantity, enhancing biodiversity and habitat, among other things. So in limited circumstances, landowners can see additional payments that might be available through either stacking or bundling the total suite of environmental services being provided by that project. Again, those are limited circumstances that may be available to landowners. So thank you for your time, and thank you for your participation and interest in forest carbon markets.